This is Trepp with a special guest podcast. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. Today, we're talking to Danielle DiMartino Booth, CEO and Chief Strategist at Quill Intelligence and former Federal Reserve insider. Danielle, welcome. Thanks for joining us today.
I'm so excited to be here. Thank you for having me.
Can you start by telling our audience a little bit about your background?
So I think in today's day and age, the most interesting thing about my background is that when I was at Donaldson, Lufkin, and Jenrette, it was prior to private equity being a thing. And so Leon Black and Schwartzman and Tony James, luminaries today in the industry in general, they were kind of commonplace because we had a merchant bank. And it's fascinating to me looking forward to see the big, huge footprint private equity has now, how unregulated they are, how the non-banking sector is $220 trillion as of the end of 2020, whereas the regulated conventional banking sector is 180 trillion. So I think that particular aspect of my past is unique, along with being inside the Federal Reserve for 9 years, when they were learning how to make the sausage of QE, and, you'd never eat off that floor. So just an interesting intersection of Wall Street, private equity, monetary policymaking, and what the world of zero interest rates and quantitative easing look like at the outset compared to where we are trillions of dollars later today.
That was a great start, and we have a million questions for you today. Hopefully we could pack them all into 45 minutes or less. But before we dive into the macro picture, interest rates, money supply, and all the impact on CRE, can you give us a little bit of sense of how you came to found Quill Intelligence? How did you pivot from your earlier careers to becoming a business proprietor?
So when I eventually became Richard Fisher's advisor on all things macroeconomic data, financial markets, and every aspect of the financial markets, I would brief him prior to him going off to every FOMC meeting in Washington. And so I would provide him a markets briefing as opposed to kind of a pure play economics, or this is the regional economy of the Dallas district. I really loved what I did. And when he retired, I retired. I cannot believe I was a bureaucrat for 9 years. But when he retired, I retired. And I've kept doing what I did for Fisher, but I do it now for institutional and also retail clients. So we've got a broad offering. We publish 8 times a week. And I absolutely love what I do, but it's not much different than what I used to do.
It's a great time, it seems, to be in that business. There's a lot going on right now. And I would think that your expertise is in extremely high demand right now.
Well, independence certainly is. And
Yes.
understanding what Fed officials are saying is also in demand.
Yeah, it's really interesting. The way you put out research and content and commentary on Twitter and other sources, you certainly don't fit the mold of a 9-year bureaucrat. So I think you've definitely found your calling in this, self-run fund that you have with putting out intelligence in the marketplace. So let me kind of get us into some of the questioning for today. So we like to say we don't speak Powell, but, we parse his remarks or the Fed minutes. We sometimes find ourselves hearing different messages, and many Wall Street analysts are hearing. Maybe you can be our Powell Rosetta Stone today and, give us some insight about what we should be taking away from the Fed chair's remarks, say, over the last 90 days or so. And I know today was interesting in terms of some of the stuff that came out, but maybe just 90 days and then maybe some immediate thoughts around what you heard today as well.
So I'm going to take you back almost 2 years very briefly and say that in June of 2021, I said I would not be surprised if the flattening trade that I was calling for at the time ended up being triple-digit negative inversion in the 2s, 10s yield curve. That happened today. In last May, I also said that Jay Powell was not going to be moving off of his stance for longer than anybody could have envisioned. People try and press him, especially with the congressional testimony. People try and press him to say, gee, maybe the 2% inflation target could be 3% inflation. So they find different crafty ways of asking him what would cause him to pivot. So in front of Congress, he said, nope, 2% is pretty much as high as we're willing to go. Next, and Elizabeth Warren grilled him about millions of people losing their jobs. And he stood back and he said, look, what if the employment rate target does get to where we anticipate it's going to be? In the past 75 years, that's still historically extremely low as we fight on battle through trying to slay inflation. So nobody believes him that he's going to stay the course. And what's much more important with Powell is that he keeps on insisting that he's going to keep interest rates high. That is something for the last 40 years none of us are used to. We are always used to him bending, especially private equity. And people who never want to have to, I mean, they've been marking to target for generations. They never want to mark to market. So nobody has a playbook. And yet it doesn't matter how often or in different ways that Powell is questioned and probed and pressed, he keeps coming back and saying the same exact thing until we get the inflation back down to the 2% target. Quit asking me.
You don't think he'll go wobbly. You're not reading between the lines. You're not seeing something that the other analysts and the rest of us are not seeing, right? You have that kind of insider view of having parsed the words for 9 years and you know the personalities and you know some of these guys that read earnings reports, they look for like the change in the inflection of the CEO's word choice, or if he's on a conference call, the words he uses. Are you seeing anything in the Powell vernacular or body language that suggests otherwise?
No, he was a little bit reticent at his press conference, and then he swatted that away within a week on stage with David Rubenstein of the Carlyle Group. I think what people have to understand about Jay Powell is that he's not a PhD educated economist. And this particular administration really did swat him around for a long time before actually letting the Senate come in and vote for his renomination. It was very embarrassing to him. He's kind of an uptight, professional lawyer kind of a person. And the last thing he wants to be is embarrassed. So does he care if he shuts down subprime auto-backed ABS? No. I think he'd rather have the banks go back to that business. Does he care if he closes CMBS? No. I think he'd rather have the banks go back to having that business as well. And that being said, what we have not seen is a repeat of late 2018 when bond issuance came to a screeching halt for 41 record days. There wasn't a single junk bond sold in the United States. He hasn't seen that. Now, lending's down tremendously. What is 85% year over year? But it's still occurring. And right now it's one bankruptcy at a time, one office building at a time, and it's controlled. There's nothing disorderly like there was at the end of 2018. And I think as long as the unwinding of the markets is orderly, Jay Powell's going to keep going.
And what are the odds that that is the case, right? He stays the course. He doesn't pivot. Everything he's saying, he sticks with. He doesn't go wobbly. Where do we look like 6 months from now and a year from now, in your opinion?
Now, here's where the rubber starts to hit the road, right? Because now you're talking about summer. And this is where he completely loses control of the narrative is the debt ceiling. And that's something that could easily force a pivot on his part, as is the slow bleeding going on with deposits being bled out of the conventional banking system. I speak to small and mid-sized banks. They're much more exposed to commercial real estate than they were going into the last cycle. You read about little banks in Arkansas underwriting big skyscrapers in New York, and you're like, that's not going to end well if there's ever a funding freeze. So my stock answer is, if we see redemptions at a high yield exchange traded fund, and you've only got 20 names right now trading, which is why spreads are so well behaved, they only reflect what's trading, not the illiquid stuff underneath it that's not. But if you see something like a high yield fund, like, oh, we're no longer taking redemptions, the world is ending, or small and mid-sized banks really begin to seize up, right? The FDIC can't broker marriages like they could in 08 and 09. Nobody's going to buy the losses that they're sitting on, the unrealized losses that these small and mid-sized banks are sitting on. They can't broker marriages, and or if the US government, decides to blow up the world with the debt ceiling standoff. Those three scenarios, as succinctly as I can put it, are things that would force Jay Powell's hand.
But I do have one more follow-up, and that is, you've switched seats with Jay Powell, and you're the puppet master. What would you be doing differently now than he's doing, if anything?
Right now, I wouldn't be doing anything differently. And I rarely say that. Because a year ago, you could have asked me and I could have said, well, I would quit lying to people about transitory. If he wakes up tomorrow and says, look, I'm trying to kill the Fed put, what's the market going to do? Look, I acknowledge that we're in recession. I acknowledge that the unemployment rate is lagging and telling us a lie. I acknowledge that the inflation metrics are lagging in nature. All these things. Let's just come out and say he's like, okay, whatever. The emperor's naked. I'm just trying to kill the Fed put because I think monetary policy making should be independent of Wall Street. Well, the markets would not like that at all. So all he can do right now is, sadly enough, be disingenuous, the same way he was disingenuous with the transitory narrative, hoping that all the high yield bonds and triple B rated corporate bonds would refinance and push those maturities out while he kept interest rates artificially low, which was really one of his goals. Mm-hmm. Nobody would really admit it. But right now he's stuck. And there aren't many easy paths for him to take, because if he was to be honest, he'd wake up tomorrow and the stock market would crash.
Right.
I got to compliment you, Danielle. You speak about this stuff with about as much passion as we do the CRE stuff. So it's really refreshing to see somebody love what they do as much as you do. It's obvious in the way you talk about this. So we're very appreciative of you being on and just sharing your insights and passion, because it's definitely coming through to us. I know it will to our audience as well. To kind of steer this back to the CRE perspective, how would you say this macro environment that we're in and some of the stuff that you've just given us, really good detail on, impacts the average commercial real estate owner or lender in today's market?
I have like an entire, whatever the opposite of a fan club is on Twitter, because I'm no great big fan of quiet quitting and working from home, because you absolutely have to have your yoga schedule intact. And I provide the example, which is only the most recent example, right? Black & Decker did the same thing a few months ago. They outsourced 1,000 finance workers from Connecticut to India. And Boeing a month ago said, we're going to hire tons of people. And then quietly a week later, they said, oh, by the way, you're going to offshore 1,000 finance people to India. So this work from home phenomena, if you will, has also manifested in work from anywhere. So you've got Google saying, share a workspace. You've got Boeing and Black & Decker and quietly others, I can promise you, offshoring many, by the way, well-paying. We're talking about accountants, finance. These are decent undergraduate degrees. They're going offshore. So you have a structural issue. This is not 2007, 2008. These office buildings are not going to refill themselves and inspire every multifamily developer on the planet to be like, you know what? I'm going to put up a high rise right next to that office community, because every baby boomer in America, millennials aren't going to leave. Gen Yers are going to come in. Baby boomers are going to move into the city so they can be hip, because 70 is the new 60 and they want to be close to a hospital. Everybody's coming into the urban area. So we're going to build huge multifamily complexes around the office ecosystem. That's not happening. We're not coming out of 2009, 2010. The Fed put's not here. Quantitative easing is not a new thing. In fact, right now it's quantitative tightening. So the avenues to refinance the debt when there's a gulf of valuation in between, where an office and a multifamily urban luxury, what they're worth and where the market is willing to finance that price, there's the gulf in between is just, you can't cross it. You need Moses, part the sea. That's what you needed. You don't need somebody savvy and shrewd I've been through many real estate cycles before. You don't need that person at the table. You need Moses.
I want to get back to that point in a minute, we will, because I have a follow-up question on there, but I want to get to something else first, which is, I've seen you on many different networks talking about various issues, but one that I saw recently was talking about the size of the US debt, the Fed balance sheet, and so forth. And we were speaking in our prep about how the size of our deficits was an issue 30 years ago with Ross Perot. And it seems to be the meteor that never strikes, right? That keeps getting bigger and bigger and bigger. And we keep talking about a forthcoming catastrophe, but the catastrophe never happens. Are we at a point now where catastrophe could happen? And if so, what does it look like?
Well, so when he was pointedly asked by Senator Menendez, Powell said, yeah, I really do think you guys should resolve the debt ceiling. I really do. He's not going to do anything to help it. And I think that is, it's a change agent to answer your question. The Federal Reserve has things that it can do to mitigate the potential damage of the fallout. If they hold their ground and do not lower interest rates, And the US government has got all this short paper that they're also going to have to refinance, that probably at higher rates than they could ever stomach. This has never happened. We've come to the precipice many times, but we've never come to the precipice with $31 trillion of debt and $250,000 per American of debt, with interest rates where they are, to where you could engulf the operating expenses of an entire country with your interest expense. And that's why I warn people that if it only took 15 votes to get a speaker, then there might be more patience. And patience would be a four-letter word in this environment. There might be more patience on the GOP's part to push entitlement reforms against a Democratic Party that wants nothing to do with them. So you could easily come to the brink at a time of very high borrowing costs for the country, for corporations, for office buildings, for residential real estate, for households.
You said yesterday that, the hidden problem that we face isn't necessarily tightening per se, it's QT. Can we get into that a little bit, and what's, most of our audience, I think, knows what QT is, quantitative tightening, right? It's the reversal of the bond purchases that took place during COVID and the explosion of the Fed balance sheet. The Fed has been on record for now, I guess, 8 or 9 months, that they've been reversing that with selling assets since, I guess, last summer, give or take. But you have a perspective about what that is going to do and what investors and analysts are missing with QT. Is that right?
Yes, it is. My mentor, Dr. Lacey Hunt, he's a monetary aggregates type. He's an old-fashioned kind of a guy. He's also got a point, because liquidity in the system is critical. And so every Friday at 4:15 Eastern, I pull up the Fed's H8 report, and I look at other deposits, liabilities within the commercial banking system of the United States. So that's down 5% year over year. So that's kind of Armageddon. The acronym of ODL, and I've got like a whole cult of good people on Twitter following ODL on a weekly basis. What that tells you is what M2 used to be if you net out hard currency in circulation and money market funds. So you don't want to double dip, right? So you net out retail money market funds. So if you're following that, it peaked out in April of 2022. It turned negative year over year in October of 2022, and it's steadily come down at an accelerating pace as what Jay Powell does not want to talk about, as quantitative tightening continues to squeeze liquidity out of the system on the last day of the month and on the 15th of every month, when those treasuries roll, when they mature. And it is steady. It is a separate form of tightening. It is being obfuscated right now by the fact that Janet Yellen is being forced to deplete the nation's checking account. Normally, Uncle Sam has to keep a minimum balance, or he loses his, I no longer have premier status at the Federal Reserve. I've just got the regular Joe Schmo on the street checking account. But normally, if you want to keep that premier status, you have to keep a minimum by law balance in the Treasury general account, Uncle Sam's checking account, housed at the Federal Reserve. Right now, because of the debt ceiling standoff, she's being forced to deplete those funds, which injects liquidity into the economy and offsets the negative effect, mitigates the negative effect of quantitative tightening. But ODL every week at 4:15 Eastern will tell you that the liquidity continues to come out of the system. And that's why we're seeing securitized markets. That's the first line of defense, and the first line of defense that's crumbling. That's why you're seeing securitization markets. There's just not enough balance sheets for banks to make those choices anymore, not when borrowing costs have tripled, quadrupled.
Yeah, so we're seeing that in terms of new issuance on the CMBS side. I mean, there's been a significant fall off in issuance really going back to July of last year, with no end in sight heading into 23. So if we look at the cost of capital, if we look at expanding cap rates across commercial real estate markets and properties, there's a huge, bid-ask spread between buyers and sellers. Liquidity is getting tighter in terms of availability of capital for deals. Do you think that buyers are just having, remorse if they purchase something in 20 or 21 or 22? Or do you think there's additional credit events? I know earlier you mentioned kind of one-off bankruptcies. Are we getting to more of a systemic type of event here, given the parameters that you've outlined?
So, every Tuesday morning I wake up and I check Bankruptcy Tracker Go. And this morning when I did it, Bloomberg said, it's very unusual. Our bankruptcy court's got a week off. We haven't had a single large north of $50 million in liabilities bankruptcy in the last week. Prior to that, you had 51 over a 3-month period, which you haven't seen since 2009. In addition to what you're seeing there, like right before we started recording today, I made note of a massive packaging plant in North Carolina that's closing. We're talking about a big building that's been manufacturing packaging for food for generations, plural, going to take hundreds of people out of business. That's not, it's under a parent company. It's not technically a bankruptcy at all. It's not a chapter anything filing. And yet you're taking something down and mothballing it. It's nothing like it was maybe a year or two ago, but the aggregate of Best Buy, Walmart's not small, by the way, they're closing stores. Bank branches are being announced like 30 at a time. PNC Bank just a few days ago said, hey, we're shutting 30 banks, Tuesday morning, Bed Bath and Beyond. There's also this depletion, if you will, of dynamism, of vivacity, of life. When you're in a city like Dallas, where I live, and you're driving down the highway and you're like, oh, look, there's an entire empty strip center. It's very public. It's a very public thing to see. And that is when you start to see it moving from, a central bank district, urban, one-off, isolated issue to really broadening out, tentacling out to the rest of the broader Sierra universe.
I have one more question, but I want to throw this one in there. Maybe it's a quick answer, maybe there's no answer to it. But I don't want to forget this one. On the QT side, you talked about Yellen depleting the reserves, which is a mitigant there. If she was not in this situation and if she was not depleting this reserve, is there any way to quantify how much higher rates would be had this QT happened kind of without this offset? Do you have a sense of this?
So quantifying where rates would be is pretty difficult. However, what we do know is that if the drop dead date, we call it the drop dead date, the date at which the US government, and we can no longer close the Smithsonian and the National Park System, and we've gone through every emergency measure we can think of. But whatever that drop dead date is, once there's a resolution, the estimates say that there is at least $1 trillion of bills that would be sold overnight. So you would hear a great big vacuum sound whoosh, come right out of the economy as $1 trillion of bills. I had somebody, presumably I was in a different time zone. So they were like 3 a.m. in the morning, which is typically when you get these tweets, Eastern time, say, Janet Yellen will never sell another bill. And I'm like, ooh, boy, make it a double, whatever he's having. As crazy as that sounds, there will be a massive fear factor when the debt ceiling is resolved in terms of how many bills that you can sell. It should be, in theory, around 400 billion plus another trillion for operating expenses of the government, because we're running record deficits. That, along with the realization overnight, hey, the Fed's been shrinking its balance sheet this whole time. Here's a double vacuum sound if you'd like. So,
Right.
Name that tune. That's why it's really difficult to say where financing markets would be right now. How seized up financing markets would be, not necessarily at this point, the level of rates you're almost getting into areas where it doesn't matter if the bid and the ask are so far apart, nobody cares.
Right.
But it's the liquidity that's in the system right now that's so critical, including that of the Bank of Japan and the People's Bank of China. They're also, remember, quantitative easing is fungible globally.
Right.
That's also another mitigating factor going on right now. But specific to the domestic health, I actually believe the crazy guy in the middle of the night, that Janet Yellen's going to be very reticent to come out as Steven Mnuchin did the last time we had one of these standoffs resolved and just blow out $1 trillion of bill sales, like within, a hot minute.
Right. That's very interesting. Let's go back to something you talked about in the very, very beginning, which was the non-bank part of the economy, right? You talked about how non-bank financing, I think you said this in the beginning, is bigger than bank financing.
220 trillion versus 180 trillion conventional regulated.
And we know that if you go back to the late 90s, the long-term capital was a function of leverage. If you go back to Lehman Brothers, a lot of what took them down was being over-levered, Bear Stearns before then.
Off balance sheet.
Right now, you have the situation where you have this inversion where their short-term cost of funding is quite high. much higher. The move in terms of basis points, on the short end has been 500 basis points. On the long end, it's been about 300 basis points. Do you see that being the next trigger for a liquidity crisis, or what we'll look back on and saying, goodness, we should have known this was coming. This is so obvious that this was the next shoe to drop?
I'll push the question back on you. I mean, at one point, CNBC had like a little box in the bottom of the screen that was tracking like a clock, whether the 2s, 10s was going to invert by a fraction of a basis point. Here we are, however many months later, going, 103 basis points, negative. There's something that's highly abnormal about the current environment. At Quill, we actually track extremely closely the BBB yield curve, the BBB rated corporate yield curve in the United States. It's a $3.5 trillion market, one rung above junk. So, whatever lives there that the Fed grandfathered in, there's a good reason that Jay Powell grandfathered in on March the 23rd, 2020, any BBB rated U.S. corporate issuer that was subsequently downgraded by a credit rating agency to junk. Because you have to safeguard this $3.5 trillion cushion, or all hell's going to break loose.
Right.
So we follow the 2s, 10s BBB curve every single day. A few days ago, it got to 7. The last time there was a mini crisis in the country, it got into the 70s, and it bounced right back up. We're almost inverted in the biggest publicly traded corner of the U.S. corporate bond market. Almost inverted, 2s, 10s, BBB.
That's extraordinary. I mean, I was looking today at the BBB minus curve for CMBS right now, and yields there are 12s, maybe even 12.5, maybe 13. I think the last deal that priced, the last conduit, was a 12 handle, if I'm not mistaken, which is just an extraordinary cost of funding.
Look, I mean, and you've got insurance regulators saying, don't buy the mezz. Wait a minute. What? How are these deals going to get done? And you're talking about 12.5% on BBB minus and a triple digit inversion. I mean, something tells me that there's an obviousness about where we are right now that should be obvious to us. And yet, the market, who cares about the market? The S&P 500 being down 1.5% on one day when we're only down, I don't even think we're down double digits over the past 12 months.
Yeah, so for those that are listening, I've been sipping on that double that Danielle ordered for us a little bit earlier, listening to all of this stuff. So I know you made a prediction earlier in the year. You said you thought industrial was maybe reaching an inflection point, industrial property as a classification. Walk us through kind of what led you to that, and maybe what you've seen that's validated that, what your perspective is now.
So I'll get personal here for 2 seconds. My husband's been running an industrial packaging company for 34 years in the great state of Texas. In Dallas, he's watched thousands of companies from California relocate to the region, and he's also watched the Amazonification of a nation. He's seen corrugated prices come down 4 times in the last few months. Incredible. Amazon, they laid down the gauntlet last year. We're going to start to quietly reduce our industrial footprint. And I'm like, well, there goes Nordstrom's. But nobody wants to connect those dots, right? But not everybody's going to succeed in e-commerce. And that's what we're seeing in the retail landscape. Not everybody's going to succeed in retail. Plus, I had a client tell me last year, I'm selling all my warehouses. It's not that there's not a future for industrial. It's that when it becomes the darling asset class that every single sell-side firm writes about, industrial's bulletproof. You can pay whatever you want, whatever that premium is. Not in this kind of a financing environment, not even for industrial with 1 billion square feet coming online fresh and new just this year. So there, color me old fashioned, whatever. I dye my hair. It really is gray, but I believe in bid and ask, and they can't be that close together, regardless of how darling of an asset class it might or might not be. As Warren Buffett once said, there's a lot of great companies out there trading at really high valuations.
That's exactly it. And I think that it does sound, when you heard about what multifamily was pricing for in early 2022, or where industrial was trading, in terms of cap rates and so forth, it did feel a little bit like 2006, which was values can never level off, and they certainly can never go down. And we know how that all played out. But let me ask you this: what is the biggest risk you think for commercial real estate in general And what are lenders potentially missing now that you think you're seeing and everybody is just really discounting fully at this point?
So I have been closely following this website called dailyjobcuts.com, and they track closings on a day-to-day basis. So since about December, we've seen 10 closings per day. One of the closings I mentioned earlier, 30 PNC branches. I more often than not see onesie, twosie. So such and such place is going to close down, this root beer stand and this root beer stand, both locations. I give you this detail because I think that what got us into this mess in the first place is what's going to be the culprit in the end. When you have a $220 trillion non-banking sector, when you have $500 billion of dry powder earmarked for commercial real estate alone, when you have people financing areas of commercial real estate that should have always stayed in the hands of the banks in the United States, and they're saying, I'll give you money, I'll give you cheap money, but I'm sorry, I'm not going to give you money to just build one more location. I need to spend more money. I've got all this dry powder that I need to personally get wealthy on because I've got my eye on this house in the Hamptons. So I need for you to build 10 locations. And then you can have the financing. We're seeing the unwinding of that financing phenomena right now. And the real damage to the economy is that you're shutting down multiple locations at once. You're displacing workers. In the same way you got the workers in there, you're pulling them out. And my issue is, I really was not liked at the Fed, so I might be a little bitter. They really did have me inside of an office on the inside of a building. It was like the Amityville Horror. You and I are old enough to remember. Get out. That was the message. But you cannot repurpose an office building with apartments inside of a building with no windows. My old building, 277 Park, which Dick Jenrette completely refurbished in 1995. It was gorgeous. Now it's considered to be decrepit and brown. So there's a 1.35, this is Trepp data for heaven's sake. There's a $1.35 billion fine on January 1, 2024. And if I'm walking away from the building, I am. The paper's got to be refinanced in 2024. It makes zero economic sense. And I don't think that even though New York office is 4 times the level of distress as its, actual footprint of, call it 11%, I get that. I don't think New York's isolated.
Yeah, it's really interesting. If we look back at the great financial crisis, everyone would cite pro forma underwriting and all this stuff that led to a lot of ballooning, loans and capital that wouldn't have been in the marketplace. If you look at the current environment, 0% interest effectively, right, has chased values all the way up because things are trading on a 2.5 cap rate on trailing 12-month income. So I think we're going to look back in a couple of years and say, yeah, underwriting standards were a lot tighter, but money was basically free and people chased the values up to a point that are just unsustainable. It's just math. You go from a 2.5, 3% interest rate on fixed money to now 7, 10, 11. The value isn't there and it's not going to be there. And to your point, it's not just New York, it's not just San Francisco. There's going to be a lot of distress in a lot of pockets. Now, to that end, a lot of properties, have a minimal amount of leverage on a relative basis, and they're probably going to be okay. Mm-hmm. But for a lot of property owners, it's going to be really challenging couple of years. And I know, you and I have gone back and forth on Twitter a few times in terms of just some of the distressed debt that's out there that needs to be refinanced. And it's going to be really hard for those deals to get done. And basis is going to be reset and someone's going to have to take the haircut.
They are. And, the wisest thing I've heard recently is, because I was having a talk, because it bothers me that my old DLJ headquarters it's going to be in distress. And the wisest thing I've heard recently is, why don't they just suck it up, be adults, and rip the damn things off the planet? If everybody wants a Class A+ building to have elevators that talk to them and read their mind and tell them what floor they're actually going to, don't push any buttons, we'll take care of you. If that's what the future looks like, because in Dallas, Texas, Goldman Sachs is going to build a monster. There's plenty, let me tell you, there's plenty of office space in downtown Dallas. They don't have to rebuild the skyline of Dallas. Dallas has been the #1 recipient of construction and relocation post-pandemic. And yet here comes Goldman Sachs, guns loaded, construction, development, state-of-the-art building, great. It's going to put more buildings in distress, relatively speaking. And what so few refuse to talk about, so few, is that at the bottom, In '07, the cap rates were double what they were in the bottom of the current cycle, with Bernanke having sweet dreams of QE and ZERP, things that didn't exist, that came riding to the rescue, and like just a can of oil, just reopen CMBS. Just like that, everything was resolved. Here's your zero interest rate policy. Here's your quantitative easing. Price whatever you want. You have my blessing. We're not there right now.
So what are the odds we get there, right? I mean, the QE had some benefits primarily for banks, right? It allowed banks to take really lousy assets and allow them to be refinanced, right? A DSCR that was 1.0x, once rates went down to 0, was 1.5, and all of a sudden that loan became performing, cash flowing, the whole thing. And if you talk to members of the Fed, or guys that I know as well, they pat themselves on the back for that. Like, we kept the number of banks from failing at 300, not at 600 or 800 by doing this. And there's some truth to that, right? That it did reduce the loan losses. What are the odds that this is where we are a year from now, that we have a crisis, we have a non-bank failure, we have a run, liquidity seizes up, everybody says, I'm not trading anymore, I'm not buying anymore because I can't figure out what this thing is worth. And all of a sudden it's back to, we got to drive rates back down to 0 again. What are the odds of that?
The odds of that are very high, in that you could certainly paint a picture of what the fall of 2011 looked like, and Standard & Poor's downgrading the sovereign debt of the United States of America. It's kind of Armageddon. So you can certainly paint a picture where what's orderly in the markets right now becomes very disorderly. But I'll shoot the question back to you. Is that going to fill these office buildings back up?
Well, it's not going to solve the fundamentals by no means, right? It certainly, the cheap money didn't solve the mall problem, right? Malls continue to lose anchors. We saw JCPenney file for bankruptcy, Sears. We saw mass closings from Macy's. So it didn't change the fundamentals. So in that particular asset class, it didn't matter how cheap money got. That was going through a structural redo, which decimated the value of that. And that's probably where offices go. Former
Trepp guest, Daniel McNamara, great guy, brilliant. He was like, Danielle, it doesn't matter what it costs. There's a fundamental structural reset in the entire sector, which I would argue will bleed into urban multifamily. Given what you're describing, which is a nasty, nasty recession, we won't even be talking about runways under what you're describing. There won't be any landings discussed.
Right. When we had Dan on, we asked him this question. At the time, we were talking about the big short too. That's what everybody was talking about with retail. Everybody was shorting retail via CMBX 6 at that time. And we joked with him, who would play him on the movie, right? If they had the big short too. We had Brad Pitt on the first one and Steve Carell and so forth. And his co-host at the time, or his co-guest, Katie, was she put out Matt Damon or Tom Brady for him. And I think he was glowing about that depiction. So I'll throw it out there to you, Danielle. Who's going to play you in the big short too?
It doesn't actually have anything to do with oceans. It really has more to do with the blind side. And that would be Sandra Bullock.
Oh, that's a great one. All right. So we have half our cast, Haley and Lonnie. We just got to have a few more guests and fill out a few spots.
And tell me Tom Brady's going to, well, anyways, I digress.
Before we close, Danielle, I don't think we threw it out there that you have more than 250,000 Twitter followers. So our listeners can certainly find you on there. But if they want to subscribe to your research or reach out to you, how can they get in contact?
So come to DiMartinoBooth.substack.com. I don't really do all of my CRE research for my retail clients because they're not really trading billion-dollar buildings on a day-to-day basis. That's more for my institutional clients who are looking to position themselves inside of CMBX. But there's all the information that you need to come in at DiMartino.substack.com. Get my daily. It rocks. No agenda. It reads like I sound, which is probably you're thinking right now nuts. But there's information there also if you want to jump over to the institutional side. So come on. And if you're bored, at DiMartino Booth on Twitter.
I am a regular reader. I look every day, and I think Twitter in general is terrific for financial news and for commercial real estate news. But certainly Danielle is on my real short list of people that I read, along with Dan McNamara and several others, Donut Shorts and plenty of others. You guys do a wonderful pro bono service for the market with your thoughts, and I really enjoy them.
Thank you. And then ask people to come pay for my non-pro bono stuff so I can pay my employees.
Well, thank you so much for joining here. I know Haley's going to take us out, but this has been a really, really enjoyable episode, and I really appreciate your time.
Location, location, location. In today's case, we had timing. So I appreciate it.
With that, we'll close this special podcast. Thank you to our guest, Danielle DiMartino Booth. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send us an email to podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the Treppwire podcast with your favorite provider. Thank you for listening and stay well.
All right.